So as mentioned, the consumer price index now up 6.2% from a year ago. It's the hottest reading since 1990. Let's dig into the reasons why. Fuel oil rising almost 60% on the year, energy up 30%, used cars up 26%, new cars up 10%, and food up 12%. Now housing is starting to rise as well, playing some catch up to home price appreciation, up 4%, but rising quickly month on month. So how can you inflation protect your portfolio? Joining me now, Cheryl Pate is portfolio manager at Angel Oak Capital Advisors, and Chris Zaccarelli is CIO at Independent Advisor Alliance. Welcome to both of you. What a day. Cheryl, let's begin with you. How should people protect themselves?
Yeah, absolutely. When we look at the data points around inflation, we're really more focused on staying shorter duration here, and particularly favorable on the financial sector. Banks in particular, consumer finance, are all leveraged to outperform in an inflationary environment, given a steeper yield curve, reacceleration, releveraging of the consumer, and still a benign credit environment.
Chris, should you stick with inflation trades, or do we start to jump ahead and say, well, like Rick said, but the Fed's going to tighten, they're going to raise rates more. Maybe that could slow the economy. Maybe it brings bond yields down, even though they've been on the rise. At what point, how far ahead of the story do we try to get here?
Well, I think at this point in the cycle, you're going to need to have some inflation protection in your portfolio. Absolutely. So I wouldn't abandon any trades that you have in place already in order to protect your portfolio. You're going to have some positions and some companies that can do well through any environment. But you're also going to continue to need to have some companies that can do well in an inflationary environment. So companies with pricing power, companies that can benefit from rising energy prices. We don't think it's too soon to take those positions out of your portfolio.
All right, Cheryl, let's talk through the positions you would specifically recommend. American Express, Capital One, Ally, SVB Financial. So are these basically rising rate plays, or is there more to the story?
I think there's more to the story. When we think about the consumer finance and the credit card companies in particular, I think this is a great opportunity for card acquisition. We saw that in American Express earnings, where they added the highest number of new card accounts in over 3 years. So it's not just higher rates playing in here. It's a willingness to borrow again and spend again, which will drive higher volumes, higher loan growth, and then the rates are added into that in terms of margin.
Shepard Smith here. Thanks for watching CNBC on YouTube.